So what's the biggest obstacle to successful investing? There's one answer to that question. It's you. Now, it's not your fault. When you were wandering the savannah several thousand years ago, probably not you, more like your ancestors, all right, you were hardwired with emotional responses designed to ensure that you ate rather than becoming the next larger thing's next meal. All right? And those emotions still run rampant in most investors' brains. Sadly, investing isn't about emotion. To be a great investor, you need to be cold, rational, logical. So in this video, we're going to take a look at one of the classic mistakes emotional humanoids make at their own expense, and that is hanging on to losers. All right? Why do we hang on to losers, and how can we stop doing it? Because it's a bad idea. All right? Now, first off, where's the evidence? All right, well, a chap called Terence Odine at Berkeley in the US, he's a professor there. He did a study a few years ago now and came to the conclusion that we are 50% more likely to sell a winning stock than a losing stock. Say that again, we're 50% more likely on average to sell a winning stock than a losing stock. In other words, we love to bank profits, we hate to recognize losses. Okay? He also worked out that on average, mutual fund managers who don't dump losers, cling on to them, okay, on average underperform their peers who are more sanguine about it by 4% a year. All right? So there's statistical evidence out there that we hate to dump losers. So in this video, I'm going to take a look at why that is, because understanding why it is might help you to actually do what you should be doing with your stock portfolio, look at the impact of it, and look at how you can kind of force yourself into being a bit more rigorous and not hanging on to stocks that frankly should have been cleaned out of your portfolio a long time ago. Right, why is it, okay, that we are so keen to hang on to our losers? Why don't we just get rid of them? All right, 3 reasons. There are more than 3, but these are 3 of the biggies. Okay, here are 3 emotional defects, if you like, hardwired into most investors. 1, overconfidence. 2, we all suffer from what's called confirmation bias. Big words, going to explain them all in a moment. And 3, okay, we all also are prone to something called anchoring. And all 3 of these are reasons why we seem unable sometimes to get rid of stocks that frankly are acting as a drag on our portfolio. Overconfidence. Let's face it, this is not a difficult one to sell. Okay? We all think we are above average drivers, especially if you're a bloke. We all think we're going to live longer than average. Why wouldn't you? We all think we can drink more than the bloke standing next to us at the pub bar. All right? And we all think we're better at investing than the next man. But of course, the law of averages says we can't all be better than average, but we all think we are. All right? Now, there's a reason for that. Overconfidence, without going into the detail, this isn't a psychology course, but overconfidence helped. Okay, when you're out in the wilds, on the savannah, on the open plain, being overconfident, being confident tended to mean that you attracted a bigger group to you. You became the group leader more naturally. All right, it translates into, in the current workplace, better jobs, bigger pay rises, and even more dates. All right, so there is a reason why overconfidence pays off in the real world. It's hardwired into us to some extent. As an investor, it presents a bit of a problem. All right, because it leads us to believe that we haven't made a mistake. Okay, we just haven't made a mistake. That share that's collapsed in price we bought yesterday will come back. Eventually it will come back because we haven't made a mistake. We don't make mistakes, we're better than average investors. All right, so we'll hang on in there. Okay, and buy and hold as a strategy is fine. All right, but it shouldn't be a kind of death grip, if you know what I mean. Okay, so overconfidence. It's a problem. It's a natural built-in feature of humanoids, if you like. It's a problem that investors need to recognize, and in a moment we'll see if we can sort of do something about it, mitigate it, take it away. Again, become those rational, unemotional investing machines almost that will actually make the most money. Okay, second problem, confirmation bias. Well, once we've made a mistake, we look for evidence that we haven't. Okay, give you an example. Take the housing market. Okay, housing market can be split into 2 groups. There are those who have properties, if you like, and want property prices to keep on rising. Okay? So when they read the newspapers, they're always on the lookout, subconsciously, even if they don't know it, for stories that confirm property prices are going to rise. There's a shortage of properties, etc., etc., etc. All right? And equally, there's a group of people who think there's a massive crash going to happen. They have thought that a few years ago. They're sitting on the sidelines. They've got cash. All right? They'll look for all the evidence they can find that property prices are falling. All right? And both groups will tend to ignore the facts in order to substantiate their belief. In other words, they have a confirmation bias. They've chosen a position, and by golly, they're going to make sure that the facts stack up with that position. And in investing terms, it can mean you scrabble around the whole time going, no, there are perfectly good reasons why I bought an investment that by any standards now looks to be duff. Okay? And all I need to do is find those reasons, and you justify hanging on. Number 3, anchoring. Now, psychologists have written many papers on anchoring. Again, it's hardwired into human brains, yours and mine. It's the idea that offer somebody a figure and they will instantly grasp onto it, okay? Even if it's irrelevant to the decision they're about to make, okay? Go back to property, okay? Very few people challenge the asking price on a property, and actually very few properties achieve the asking price. Usually there's quite a big gap, but estate agents know that just by having an asking price, even an unrealistic one, people will start to manage their expectations about what the property is worth upwards, all right? And studies have shown that if you set the initial price in any negotiation low, the two parties will tend to merge towards it. Set it high, and they'll do the opposite. Which is why, by the way, great advice in any negotiation is if you think the other side's opened with a daft number, walk away from the table. Don't even be tempted, as your little subconscious brain might be, to go, well, maybe the number's not so unreasonable after all, maybe I should join in this negotiation, right? Better to walk away, because otherwise anchoring might just start to creep in there and take hold. Now, as a stock investor, what does all this mean? People get anchored to the price they paid. They go, well, I paid £4 a share, I'm not selling until I get £4 a share, minimum, okay? But £4 a share last week might be totally irrelevant. If the facts have changed, the share price may never get back to £4 a share, okay? I've been guilty in the past of buying shares that have just continued heading south, and I've done it myself. I said, well, if I at least get back to break even, yeah, then I'll sell, then I'll be happy. It's not going to happen, okay? I'm anchored on a number that's just now completely irrelevant. People do it with property, they do it with shares, they do it with all kinds of things in practice. Okay, so those are 3 reasons why, if you like, we almost can't help, in some respects, hanging on to losing stocks, probably for longer than we should. But help is at hand. Okay, how can we take away some of these emotions? How can we make stock selling? And the reason I picked selling in this video is because there's an awful lot of stuff out there about buying stocks, when to buy, how to buy, but a little less on selling. And selling matters because if you leave your money in a duff stock, there's an opportunity cost. People think, don't cost me anything, I'll just wait, see what happens. Well, it does, because that money could be invested somewhere else and be earning a better return. So you are losing out by leaving your money sat in underperforming stocks. Okay, so what are we going to do about it? One mechanical option is a stop loss. Okay, now there are drawbacks to stop losses, but what are they? A stop loss is simply this idea. It's the idea that you buy a share at, say, I don't know, £3. You ask your broker for a stop loss of, let's say, 10%. Right? What that means is, having bought, if the share price falls 10% or more, you should be kicked out of the position to minimise your overall loss. So if you're buying at £3, a 10% stop loss level, that suggests it could drop around 30p, so you'd expect to be kicked out of the trade at £2.70. If nothing else, that will force you out of a losing position. Okay? How do you pick 10%? Well, that's an interesting question. All right, and the problem with mechanical stop losses is that there's 2 things. One, you may be kicked too early out of a trade where there's been a bit of volatility and actually there's a rising underlying trend. And secondly, with a standard stop loss, okay, you don't get the opportunity sometimes to actually bank gains. What do I mean by that? Well, there is another type of stop loss available through some brokers and through some electronic trading platforms called a trailing stop loss. Now, this could also be set at 10%, but what happens is the stop loss level follows the share, hopefully upwards. Okay, so for example, if you were to buy a share at £3, and the stop loss is set at 10%, so you're going to be kicked out at £2.70, right? And then the share climbs to £3.50, suddenly the stop loss moves up to 90% of that price. Okay, so the stop loss now kicks in 35 pence below the new £3.50 level, or at £3.15. What that means is you can lock in 15 pence of gains even if the stock subsequently falls. Whereas with a plain vanilla stop loss, you won't, because it won't kick in until you get back to the original level you set the stop loss at, which if that was £2.70, well, that's where the stop loss kicks in. So the advantage of a trailing stop loss is it actually follows a share up and then kicks in to at least preserve some of the gains if it subsequently collapses. Okay, so that's kind of a mechanical way you can protect yourself from not selling, because the stop loss will sell for you. All right, you know, even if you're on the tube at the time or asleep, a stop loss can activate and dump shares that perhaps you need to get rid of. However, not for everybody. So what else can you do? Right, other options. Think about why you bought and wrote it down. An awful lot of people buy and then forget. Okay, and they can't remember weeks or months later what their criteria for buying were. And hopefully they had some logical criteria. They looked at ratios, and I deal with those in other videos. They looked for low PE ratios, a low price to book, or high dividend yields. They had some reasons. Good management team, unique product, unique license, unique place in the market. There were reasons why they bought. Write those down at the time you buy the shares and review them. All right? And if the facts have changed, you need to change with them. Okay? So if some of those unique buying points, if I can call it that, don't exist anymore, okay, then maybe it's time to think about selling. Right? So I call that sort of an active, monitoring strategy with your portfolio, rather than just buying and forgetting and going on to the next purchase. Investors do that. They like to buy things and they forget sometimes that in order to take out profits, eventually you're going to have to ultimately liquidate as well. Final tip, ask yourself this question. If the stock's dropped, ask yourself the question, would I buy it at today's price? If I was starting from scratch, I already own it, it's too late, but would I buy it at today's price? And if the answer is no, what are you doing hanging on to it? Maybe it is time to think about selling it. Because if you wouldn't buy now, what were you thinking of buying at even higher price a few weeks, months, or even years ago? So that's another good test. Now, if you want to know more about some of these investing psychology themes, because I covered them very quickly, overconfidence, the confirmation bias, and anchoring, then do have a read of one or two of the books produced by Nobel Prize-winning psychologist Daniel Kahneman. That's a very good place to start. All right, and on stop losses and trading stop losses and the criteria for buying shares in the first place, do have a look at one or two of my other videos that deal with those themes. But the message in this one is very, very simple. We're prone to spend all our time worrying about when to buy, not a lot of time thinking about when we sell. That's a mistake, especially since we're hardwired to avoid selling and recognizing sometimes that we need to. And that can cost you money over the long term as an investor.